Welcome to Accounting for Business 22107. In this clip, we're going to talk about understanding debits and credits. For a lot of students out there, this is the most complicated piece of learning accounting. However, once you get it straight, it's actually pretty simple, very simple. But there are a few rules you need to memorize. Well, we're going to show you some of the basic accounts and how their debit and credit sides work.
Debit and credit doesn't sound that hard. So what is debit and credit exactly? A easier way to write debit is to write DR, which also means debit. So where did this word start and come from? Debit comes from the Latin word debre, which means to owe. Just to clarify, debit is always on the left side no matter what. And how about credit? There's an easier way to write credit. We write CR. And credit comes from the Latin word credere, which means to trust. And it's always on the right side no matter what. So we all know the accounting equation, which is assets is equal to liabilities plus owner's equity, or A is equal to L plus OE. And if we expand it, we get assets plus expenses is equal to liabilities plus revenue plus owner's equity. There's nothing in this, but just to need to memorize these formulas and need to know this for your whole accounting life. There are some cautions which I would like to take before proceeding into the depth of accounting. First of all, do not assume debit means decrease or credit means increase. Do not confuse yourself with a credit card or a debit card. Or do not confuse yourself with when you receive a bank statement and it's written CR or DR. Therefore, if we take all these points in consideration and think about it, we can think about it this way. We all know the basic equation, assets is equal to liabilities plus owner's equity, and we've said that debit is always on the left side no matter what, and credit is on the right side no matter what. If we connect these two facts together, we can say that debit is equal to credits, which is correct. Thus, we can also say that debit is equal to assets, whatever's on the left side of the equation, and credit is equal to liabilities plus owner's equity, whatever's on the right side of the equation. So what accounts increase and decrease debit and credit? The image picture shows a quick overview of what accounts increase and decrease debit and credit. But on the next slide, we'll be explaining a technique which you'll understand and implement to understand what accounts increase, decrease debits and credits. It's a bit complicated, this part, so pay attention. So let's learn it the easier way. Remember this word, DR, P-A-L-E-R, which is Dr. Pillar. DR stands for debit. P stands for proprietorship, which also means owner's equity. So proprietorship is another word of owner's equity. A stands for assets, L for liabilities, E for expenses, and R for revenue. And how does this help or work for us? How would this help us? Well, there's a basic knowledge that we need to know, and we should know this by now, that assets increase when it's debited, so we get an increase. By doing this, we can make a pattern up by showing that owner's equity decrease, liabilities decrease, equity increases, and revenue decreases. As you see, there's a pattern there. And the opposite goes for credit. For equity or proprietorship, it increases, assets decrease, liabilities increase, equity decrease, and revenue increases. Let's do a quick overview of T accounts and journal entry. So the T account, what have we got on a T account? We've got the account title on the left side, we've got the account title, we've got debit on the left side and credit on the right side. There's a few simple rules about T accounts. First of all, when we have assets, increases are recorded on the left debit side, while decreases are recorded on the right credit side. So positive on the left debit side and minuses for the right credit side. And for liabilities and owner's equity, decreases are recorded on the left debit side and increases are recorded on the right credit side. Now let's look into journal entry. That's basically a journal entry, but let's learn a few rules on how to write journal entry. The date of the transaction, the title of the account debited, the title of the account credited, and just look at this, it's indented slightly, very slightly. We've got the dollar amounts on the left for debit and credit on the right. We've got a short explanation of the transaction. It's easy stuff, nothing too hard. Now let's look at an example. This is John. John owns a barber shop and he cuts Michael's hair on the 10th of July. Michael pays John $20 for the haircut. Thus, John gets cash of $20. John will have to debit cash and credit revenue. Why credit revenue? Because John is providing a service to Michael by cutting his hair, and thus John, being owning a barber shop, receives cash by providing a service. Thus, we call it account revenue, and thus we credit revenue. How would we write this on a T account? We've got assets, cash at bank, and liabilities revenue. So we credit assets left side and we debit revenue on the right side. How would we do a journal entry? We've got the date July 10 when Michael came in to do the haircut. We've got the cash at bank, which the account debited $20, and revenue, which we credited $20, and a small explanation saying received revenue from customer Michael. That's about it. It's all easy stuff, and I hope you've learned a lot and hope you've enjoyed the video. Thank you.
I hope you understand the debit and credit part of this subject, and I hope my comrades have done a great job in getting you ready for the final exam.